In the 2 weeks since my last client notes, stocks have been treading water at support. The balance between buyers and sellers is in perfect equilibrium at the moment. The bulls see the correction as mostly having run its course and the current market representing a buying opportunity. David Bianco, chief U.S. strategist of Bank of America Merrill Lynch, was on CNBC 2 Thursdays ago telling investors to stay focused on the fundamentals and not be distracted by peripheral issues like the market action and what's going on in Greece. He said to pay attention to record earnings and record low interest rates, which suggests this is a buying opportunity. Michael Santoli's mystery broker also believes that the correction has pretty much run its course and the market will trade in a range into late summer or fall before a year-end rally that will take the S&P up to around 1,400. And in favor of the bulls, corporate earnings through May continue to be superb. Last Tuesday, Federal Express reported solid volumes and pricing for its fiscal fourth quarter. The international division was phenomenal. The same day, Bed Bath & Beyond, the big home furnishings retailer, reported a 7% increase in same-store sales for its quarter ended May 31st, 2011. So, superb quarter. Thursday, Oracle, the big business software maker, reported a 19% increase in new software license revenue, even though the stock got hit because of a 6% decrease in hardware products revenue. And after the close today, Nike reported an excellent quarter with a 12% increase in future orders and 14% increase in revenue for the quarter ended May 31st, 2011. From a valuation standpoint, none of these stocks are overvalued. Bed Bath & Beyond and Oracle trade with a low teens multiple, and Nike and FedEx trade in the high teens. So how can you be bearish, given the strong fundamentals and attractive valuations? Well, I remain bearish because I believe we're on the verge of a financial market breakdown. Why would financial markets break down if corporate earnings are strong and valuations are attractive? Traditional theory contends that financial markets reflect underlying reality. However, my own belief, following George Soros, is that the relationship between the two is far more complicated. There is reflexivity between the two as each influences the other in a dynamic back and forth. This is even more true as financial markets grow in size in relation to the overall economy. In September 2009, a client note called The Wisdom of George Soros, I explained how the government's reflation of financial markets had put a floor under the economy. Now, with the end of QE2 in conjunction with market topping action since February, it suggests to me that we're about to experience the other side of the coin. Without the continual injection of new money from the Fed, my guess is that the risk trade will reverse itself. Money will flow out of commodities and emerging markets and into safe havens like the dollar and treasuries. This will cause deflation in financial markets. The effects of all the newly created money, which reflated asset prices and bolstered bank and consumer balance sheets the last few years, will shift into reverse. With their assets deflating, banks and consumers will cut back on lending and spending. This decrease in end demand will hit business and cause a contraction in the overall economy.